Currency College, Chapter 1, Introduction to Foreign Exchange. Forex, a brief history. Currency trading has a long history that can be traced back to the ancient Babylonians, who first devised bills of exchange, which were transferable to a third party. This allowed payment flexibility. A trader did not actually have to take delivery of a herd of pigs in order to be able to turn around and sell it. Egyptians are the first recorded traders to begin exchanging coins from different countries and national groups. However, the history of the Forex that concerns us is more recent than this. By the mid-1930s, London became the leading center for foreign exchange, and the British pound served as the most traded international currency and as the reserve currency of most nations. However, at the end of World War II, the British economy was almost completely destroyed, along with the industrial production capabilities of Germany, Japan, and most of Europe. The United States emerged from the war as the only major participant unscarred by war. In an attempt to avoid the same devastating economic conditions that resulted from post-war policies after World War I, representatives from 45 nations met in Bretton Woods, Pennsylvania, USA, in the summer of 1944. As a result of this meeting, the International Monetary Fund, IMF, was created that began rendering financial support to the former socialist countries as they began to rebuild their economies. It also resulted in an agreement that fixed currencies and an exchange rate system that tolerated 1% currency fluctuations to gold values. In turn, the US dollar was pegged to gold at $35 per ounce. As a result of this agreement, the United States dollar became the reserve currency for all the capitalist countries, and all currencies were pegged to the American dollar through a system of currency exchange rates that were maintained by the central banks of the participating countries. For nearly 30 years, this protected global market allowed countries torn by the ravages of war to rebuild themselves. However, near the end of the 70s, with most of the participating countries' industrial might rebuilt, the pegging of currencies against the US dollar actually prevented nations from improving their global economic standing. In 1973, under the leadership of President Richard M. Nixon, the United States effectively abandoned the gold standard as the basis for US dollar value, which effectively nullified the Bretton Woods Accord. Shortly thereafter, a free-floating system of international currency exchange rates was officially mandated by the IMF, which led to the formation of the modern foreign exchange market, wherein central banks exchange currencies among themselves, but only in lots of $1 million. Because of the lot size, this made trading the Forex spot market the exclusive playground of international banks and corporate financial institutions. However, in 1998, fueled by the Commodities Futures Modernization Act in the United States and the development of internet dealing systems, now most anyone can trade currencies in the foreign exchange spot market. Over the years, the foreign exchange market has experienced spectacular growth. Daily average volume in 1977 was US 5 billion, 600 billion in 1987, and reached the trillion mark in September 1992, and now averages between $1.5 and $2.5 trillion on any given day.